In a bid to protect the financial system, Swiss regulator FINMA has written off $17 billion of additional Tier 1 or AT-1 Contingent Convertible or CoCo bonds of Credit Suisse. This has triggered investor anxiety, much like when the Reserve Bank of India wrote down Yes Bank's AT-1 bonds in early 2020 to bail out the stressed private lender. In this video, we will dive deeper into the world of AT-1 bonds, their purpose, and the implications of these two events. Now, what are AT-1 or CoCo bonds? AT-1 or CoCo bonds are high-yielding bonds with the characteristics of equity shares sold by banks to raise capital. These are designed to help banks meet funding needs in times of stress without reaching out to the government. Contingent bonds can be converted into equity when a bank's capital level falls below a specified threshold. Now, what happened at Credit Suisse and Yes Bank? In both cases, holders of the AT-1 bonds saw their value fall down to zero. In addition, there are allegations of mis-selling of the instrument by Yes Bank's erstwhile management, which led to investors who did not qualify to buy them. Also, some were unaware of the associated risks of buying these securities. In the case of Credit Suisse, there are no such charges yet. What are the similarities between the two write-offs? In both instances, equity investors got some value from their investments, even though they should technically be the first set of stakeholders to see the investments written off during bankruptcy. While there has been no official communication on what happened in Yes Bank in the CS case, there is speculation that it might have been done to avoid litigation. In addition, the UBS takeover of CS is done without shareholder approval, which is otherwise a legal requirement. Now, how will the CS issue impact the market for AT-1 bonds? We see the prices of CoCos of weak European banks sliding, and the number of takers for future issuances may also shrink. Yield investors' demand may also rise for new issues as buyers factor in bigger risk. Now, what is the conclusion? The world of AT-1 bonds is seemingly opaque, but recent events at Credit Suisse and Yes Bank shed some light on their purpose and implications. However, the regulatory framework established after the global financial crisis emphasizes that equity shareholders should primarily absorb losses. Only after all common equity Tier 1 capital has been depleted should AT-1 bonds be written down. The similarities between the two write-offs raise concerns about the regulation and the protection of the investors.